Okay, you guys, so we're going to go head right into video 3 where we're talking about the capital gain versus rate. So basically, capital gains are any amount of money that you receive from the sale of an asset. Such as a building or rental property or your personal property. So if you sold your personal property for 100,000 and the net value, the net worth of it was 80,000, you made a $20,000 profit. That $20,000 profit is taxed on the capital gains rates depending on how you held that capital gain. If it was held for less than a year, it's taxed at ordinary income, and those are the rates that we initially went through, such as the 10%, the 12%, depending on how much money you actually made for the years. Now, if you held that asset longer than a year, then you are subjected to capital gains tax rates, and this is what he's talking about right now. I'm gonna let the video finish out because it's about 15 minutes, and then I need to do 2 more before the night is out. But make sure you guys look at these videos and get through the information, because we do have some tests that are coming up.
Tax rate instead of the ordinary income tax rate. Now, if it's a short-term capital gain, meaning your client held the asset for less than 1 year, then it's taxed as ordinary income. If your client held the asset for more than a year, then it's taxed as capital gains at lower rates. The only way to qualify for that is if they're held for more than a year. Capital gains tax rate applies when a taxpayer makes a gain by selling a capital asset that they've held for over a year. And net long-term capital gain means long-term gains reduced by long-term capital losses, which can also be carried over from previous years. Notice something. We cannot take a long-term capital gain and offset it by any other type of loss other than a long-term capital loss. I bring this up because it's really in the news right now when we talk about capital gains rates. Cryptocurrencies. A lot of your clients are trading in cryptocurrencies. If they're just held for investment, and they're held for more than a year, and your client is not day trading them or buying and selling them, then they are a long-term asset, and they are going to get the more favorable capital gains rates. If they're not doing that, if they're buying and selling as the prices wildly fluctuated in 2017, wildly. We saw swings of 10,000 points per week sometimes with different cryptocurrencies. So traders would buy and sell, and thinking there was one thought in their mind that these are not regulated currencies. They're not subject to income tax in the United States. The federal government and the IRS has made a very clear stance. They are subject to ordinary income taxes. If you're day trading them and you have gains and losses, you are subject to short-term rates, which are what? Ordinary income tax rates. And what has happened since the government made that pronouncement? The prices have started to stabilize. People see them now as just an investment as opposed to a potential currency that cannot be taxed. It's taxable in the U.S. It's stabilized a little bit of that market as we stand here today. It may not be that way tomorrow. And now we understand the taxability. Just like with stocks and bonds, it's very tedious, time-consuming. I would make sure that your clients have great records of what they bought and sold for, and whether they're receiving 1099s for their gains, and they should be reporting them. Even if they don't receive 1099s, they should be reporting them, and then you have to make the determination of, do they get the favorable capital gains tax rates or not, and think about that. So let's take a look on slide 13 at the capital gains tax rates. These don't really change much except for our brackets. There is a 0% rate for people who are in the 10 or 12% ordinary income tax bracket. So when you see the taxable income limitation of $38,700 at 0%, that's because those individuals are in the 10 or 12% bracket range, except for head of household. Remember, head of household, that first bracket was much bigger of a bracket. So do keep that in mind. If your client is filing head of household, they have a higher bracket that they could be in. If they are in the 22% or higher bracket, the capital gains rate is 15%. If their taxable income exceeds $200,000 as a single taxpayer, you have to add the 3.8%, which is what we've done on the slide for you. The rate becomes 18.8 or 23.8. Upper income individuals with income over 425.8 for single taxpayers, again, you see that 20 plus the 3.8. A couple little points to make here. If your client has taken straight line depreciation on a commercial property and sells that property, the depreciation recapture tax rate is 25% flat. Okay, maybe I was just speaking a different language to some of you. Let's talk about that again. If your client sells a commercial property, let's say they had a property, they bought it for $100, and you've been depreciating it for them over the years, and now it's down to $50. You've depreciated it down 50. The basis is still 50. Hypothetically, let's say the client sells the property for $100. So what happens? 50 is basis. That basis is tax-free. Your client pays no tax on it. The additional 50 is what we call depreciation recapture. And if it is commercial real estate, is not subject to these long-term capital gains rules. Don't get that confused. It's a very tricky topic for accountants, CPAs, enrolled agents, and you tax return preparers. That extra 50 is taxed at a flat 25%. What's the IRS trying to do? They're trying to recapture the benefit your client took when they depreciated the property. Now, let's do another hypothetical. Let's say the client sells the property for $150. What happens? First 50 is tax-free. The second 50 is recaptured at 25% flat tax rate we talked about. But now they're above the original cost. Once they go above $100, which is what you started depreciating the property for, if they held it for more than a year, now they fall into these categories. What's their tax rate? Where do they fall in? What's the gain on that? Well, they made $50. Do they pay anything at all if that's their, it depends on what tax bracket they're in. If they're in a low tax bracket, they may pay nothing on it. But don't get trapped. Don't tell them, oh, you're not going to pay any tax because your income is so low and yet you sold this piece of property you had that we were depreciating, but you're in a 0% bracket. That doesn't work if your client depreciated the property. Now keep in mind too, you don't have to depreciate the property. If your client doesn't need the depreciation on his tax return, then you don't need to depreciate it. And you can save that basis for your client, that $100 of basis, for when they do go to sell the property, if they really don't need the depreciation. Okay, I'm on slide 14, and we're looking at married couples. And again, long-term capital gains tax rates. So they're a little bit different. $77,000 up to $77,400, it's a 0% tax rate. $77,400 to $450,000, it's a 15% tax rate. Once again, now we jump over 250 as opposed to the previous slide where we jump at an individual, we jump at 200. A married couple, we jump at 250, and we're at an 18.8% tax rate. Why? We added the 3.8% Medicare tax rate. And then if we're over $479,000, we're taxed at 23.8% on our long-term capital gains. So where do we report these long-term capital gains? They're reported on Schedule D, as in Delta, of the Form 1040. It's attached to the 1040. If it's required to be attached, you attach it. And where did we see it on the line? It was currently on line 13. That line might change, but currently it was on line 13. In part 1 of Schedule D, and we're going to look at this, you report their short-term capital gain and losses, which are, again, assets they held for a year or less. Part 2, you report the assets they held for more than 1 year in the Schedule D. So we're going to look, I'm on slide 15, and we're going to look briefly at Part 1 and Part 2 and Part 3 of the tax return because of the changes to the rules on depreciation and recapture and ordinary income tax rates affecting our short-term gains and capital gains rates affecting our long-term gains. I wanted to make sure that we're overall have a good familiarity with Schedule D. To figure the overall gain or loss from transactions reported on Form 8949, you use Schedule D. You use D to report transactions that you don't have to report on 8949. There's a couple of other forms. If you have a gain or loss from Form 4684, 6781, or 8824, you're going to use a Schedule D. If you have a gain or loss from a partnership, from an S corp, from an estate, a trust, you're going to use a Schedule D. To report a capital loss carryover from 2017 to 2018, you're going to use the Schedule D. There's a lot of other reasons why you're going to use the Schedule D, but I just wanted to highlight those reasons. A few. Okay, let's look at slide 16. So we're looking at what currently exists as the schedule, labeled capital gains and losses, and as you see in the upper right-hand corner, it says 2017, and of course that will change to 2018. Notice one thing at first, on all of your forms, you should always put the name and the Social Security number on the form. So if for some reason you're filling out a form by hand for someone, you're not using any kind of a software program, make sure that you've got the name in there and their Social Security number on every Schedule D that you do. So looking at Part 1, take a look what it says. Short-term capital gains and losses. These are assets held 1 year or less. And you put in the columns. You can see the different columns under 1A, 1B, 2, and 3. We have these different columns where we'll put in all of the factors, and on the final right-hand side of the column, we're going to show, was there a gain or loss with the asset that we held short-term? And I want to draw your attention to line number 5, where it says, look at this, net short-term gain or loss from a partnership, from an S corp, estate, and trusts from Schedule K1. If you're not familiar with that, that's the schedule that the business is going to produce to show whether you had a capital gain or loss in the business. And that shows up right here on line 5. That should also tell you something when you're filing tax returns. You cannot file an individual's tax return unless you have their K1s. If they have an interest in a business that's filing a separate tax return, or look at the last 2 comments in line 5. They have an interest in an estate. Did someone pass away during the year and they're a beneficiary? Or do they have a trust and they're a beneficiary of a trust? There's different types of trusts out there. You have to wait for that K1 to come in. What happens if you don't wait for that K1 and you fill out that tax return for the client? Well, you're going to be amending the tax return when the client comes in and says, hey, I just got this crazy looking form in the mail and it says it needs to be on my tax return. And now their tax situation has changed. Or the IRS is going to contact your client and say, you filed your tax return, but you omitted your K1 income. So now you have tax on the income, you have an underreporting penalty because you underreported your income, and now you have interest on there as well. You as the tax return preparer, as you know, under Circular 230, you're charged with the duty of doing your due diligence, asking your clients for the information. You don't have to verify its accuracy, but you have to verify the fact that my client represented to me that they did or did not have a K1. If you don't ask your client that, could you be on the hook for a penalty or a reprimand under Circular 230? And will your client be upset with you? Potentially both. Yes, absolutely. And that's why I wanted to bring your attention there. Looking at line 6, if you have a loss from a previous year, that's where the capital loss carryover comes in. And you can see there's parentheses around that number. It becomes a negative number. It reduces the potential gain on the capital short-term capital gain.
And you
So
guys
take a
got the
look.
PDF
We're gonna
for
break.
this, so make sure you review the PDF. The PDF it goes into great details, a lot of the information he's breaking down. So outside of looking at the videos, make sure you look at those PDFs. You get familiar with the tax schedules and also the forms, so that you won't be surprised when you see a K1 or you see Form 8949. You'll know what those forms entail. And we're almost done with this video, so I'm going to let him ride it out.
Down a couple of these lines for you on capital gains. On slide 17, we're looking at transactions not reported on Form 8949. So this is line 1A, go back a slide, and line 8A. 8A is part 2 of Schedule D, showing long-term capital gains. And look what it says. Totals for all short-term transactions reported to your client on Form 1099-B, for which basis was reported to the IRS and for which you have no adjustments. Let's talk about basis for a second. I can't tell you how many times my clients have come to me and say, well, I sold this property. I sold this investment. And they say, I don't know what kind of tax I have to pay on it. Well, my first question to them is, did this cost you? I'm going to give you an example. Many years ago, I had a client call me and say, Roman, I need to report the gain of my subdivision units as taxable because I've started to sell them. And I asked my client, I said, well, what have you put into them? What did this cost you? I kid you not. His response to me was, I don't know. I don't remember. I don't think I put anything into them. And I asked him, I said, wait a minute. Did you buy the land? Well, yeah, I bought the land. Did you put a road in? Yeah, I put a road in. Did you put plumbing in? Yeah, I ran sewer lines and water lines. Each lot has a tap. That's all basis. He's like, yeah, but I spent all that on my own, and now I formed a company. It's basis, which maybe was not reported to the IRS. That's basis. When you sell something, the return of basis is tax-free if you've not depreciated it. And land, in this example, land is not depreciable. If we put land on our books for $100, we don't depreciate the land. We can put improvements on there, and we can depreciate improvements. I bought land. I built a home. I'm going to sell the home. Or I built a building. I built a storage building. I can start to depreciate the building, not the land. Lo and behold, we had some basis. Lots of people don't keep track of that. So what did I have him do? I said, hey, you've got to go back and find those receipts. You've got to go back and tell me and show to me how much can you prove basis. And all of that is tax-free. It may be short-term capital gain, ordinary income. It may be long-term capital gain and capital gains rates. Just give you an example here of how we report basis to the IRS. Your client received a 1099-B reporting the sale of stock they held for 3 years. It may show proceeds. It's a 1099. It may show proceeds in box 1D Delta of $6,000, and it may show cost or other basis in 1E of $2,000. Box 3 of the 1099 is checked. What does that mean? That means that the basis was reported to the IRS. The IRS has a record that you bought something for $2,000. You don't need to make any adjustments. Maybe this was your only transaction for the year. So you can report it right here on Schedule D because your basis was reported to the IRS. And you'll show that gain of $4,000 as taxable gain on that.
Okay, you guys, that concludes video 3. We are moving along. So I will upload the other videos tomorrow morning. Make sure you go through them, and I'll talk to you guys later.